You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. As the Fed continues to fight the difficult last mile of high inflation, some analysts wonder whether changes in the post-pandemic economy mean the ideal inflation target is now higher than 2%. While the Fed's policy goals have not been set in stone throughout its history, changing the inflation target could threaten the central bank's credibility in fulfilling the promises it has made to consumers, businesses, and financial markets. On today's episode, we talk with Chris Lowe, chief economist with FHN Financial, about the history behind the Fed's 2% inflation target, the pros and cons of increasing the target rate, and who the winners and losers would be in a revised policy regime. Stay tuned. Coming up soon, our interview with Chris Lowe, chief economist with FHN Financial. For complete context, we recorded the interview towards the end of May before this week's Fed decision and May CPI release. But first, a quick market update. The Fed left interest rates unchanged this week, as expected. FOMC participants' rate cut projections for 2024 declined versus the March meeting, also as expected. The median projection is for one cut this year, but 8 of the 19 members of the committee are projecting 2 cuts, putting the Fed's expectations roughly in line with what the bond market is expecting. Fed officials seemed only marginally swayed by the encouraging CPI data that were released earlier in the morning. The 0.16% increase in the core CPI was lower than all economists' estimates submitted to Bloomberg. The cooler price pressures were broad, especially in categories like auto rental and auto insurance that have pushed up recent inflation reports. This release is certainly what the Fed is looking to see when it comes to the greater confidence it wants before cutting rates. But it is only 1 month of data. In this way, Fed officials were prudent to not change their 2024 projections too much because of the exciting report. Also this week, the May PPI came in much lower than expected. Slower increases in producer prices will help with consumer price inflation down the road, but we see this month's report as a reversal of the unusually large increases in April. Smoothing out the 2 months of data, producer price inflation is not overly concerning, and the May PCE deflator should come in relatively low when it is released at the end of this month. Last week, the May employment report showed strong job gains after some April weakness, reinforcing data elsewhere suggesting a moderating yet robust labor market. The unemployment rate did tick up to 4%, in part from higher participation and the 20 to 24-year-old age group transitioning into unemployment around graduation time, a fairly typical occurrence this time of year. Treasury yields have drifted 20 to 25 basis points lower over the last 2 weeks after the busy data calendar and Fed meeting. Although the employment report prompted a significant sell-off last Friday, the encouraging CPI and moderating ISMs were enough to calm investor fears of an overheating economy. That's all for the market update this time. Now, our interview with Chris Lowe. Our guest today is Chris Lowe, chief economist with FHN Financial. Chris, welcome back. Thanks for coming on the podcast.
Hey, Will, good to be here.
Our topic today is the Fed's inflation target, the history that led up to its current 2% target, and whether they should consider changing it in the future. Chris, I want to start out with a relatively simple economics question. Why is the ideal inflation rate not 0% or even lower?
It was for a really long time. In fact, the Fed's mandate is still full employment and stable prices. And for the longest time, in fact, through until the late 1980s, it was well understood that price stability meant no inflation. And I can remember early in my career, every time Alan Greenspan testified to Congress, he would have to explain why the Fed might stop fighting inflation before reaching that goal, why a low level of inflation. They didn't have a specific target back then, but some inflation was better than no inflation at all. And the primary reason was because if you're targeting zero, you're going to spend some amount of time below zero. And the understanding in the US since the 1930s was that anytime you have deflation, there's a risk of a debt deflation spiral, which can lead to a very deep recession that's hard to get out of.
Yes, and I think that was one of the primary problems of the Great Depression, that there was such a shortfall of aggregate demand, and we went into one of those deflationary spirals. And so, right now, central banks around the world seem to be pretty coalesced around this idea that 2% is a pretty good number. It gives enough wiggle room to avoid that deflationary spiral, but also it is not too high that it erodes people's ability to read the price system very easily. So, how did central banks decide that 2% was the optimal inflation level?
New Zealand was working on new legislation for its central bank, and they decided they would have an inflation target, and that actually the head of the central bank could be fired for not hitting that target. The goal was to have accountability, but still independence. And so they were the first major global central bank to adopt an inflation target as opposed to something like a dual mandate that we have or the full employment mandate that some other central banks had at that time. The question was where to set the target. There were different views within the legislature, and it just happens the most sort of avid fan of a zero target was in the hospital on the day they had the vote. So he
Huh.
missed the vote.
Huh.
And in the meantime, somebody else suggested it ought to be 0 to 1. And someone said, yeah, that's a good idea. But, two might work better because that would give us a little more wiggle room, a little less pressure on the bank to perform. So they just went with it. So it was a number picked out of the air. But I think the really important thing about that number is that it had an unexpected outcome. And that is when they announced inflation would be 2%, it went to 2%. And the reason was the public believed the central bank could enforce a 2% target, and therefore inflation just sort of went there naturally. And it was the beginning of this idea that inflation expectations and an explicit target are somehow linked.
That's so interesting. Not only that 2 is kind of an arbitrary number, but it ends up becoming very important just in this self fulfilling prophecy. And so I want to get actually into the Fed's dual mandate specifically that you mentioned. So, one part of it is full employment, and then the other isn't a 2% inflation target, it's price stability.
Right.
Over time, if it used to be considered that 0% was the ideal inflation rate, how did we get to where we are today? How has the Fed's inflation targeting changed throughout its history?
Well, it's changed a lot. In the beginning, in the late 80s and early 90s, Alan Greenspan, of course, was the Fed chair. And he started talking about wanting to avoid the danger of deflation. Now, at the time, we're talking about decades of very, very high inflation in the US. So the idea of deflation was sort of preposterous to people. But Greenspan was one of these deep thinkers and a big fan of economic history. And, in a way, it's a good thing he thought about those things because we did have deflation not that many years later. But he decided we should have a target between 0 and 1%. And that gave enough room that if we missed a little bit, we'd probably still be in the range. Later, he decided it would be safer and probably better to have a target of 1 to 2%. And that was where we were when Ben Bernanke came in and the Fed decided they wanted to codify it. Instead of having this stated sort of not necessarily official target range, they wanted to come up with something more explicit. So they went with 1 to 2% for a while, but apparently influenced by Janet Yellen, who again argued that we want to stay above 0 if we can, they ultimately settled on 2, which of course is where we are now. and it's written into the Fed's annual stated policy goals.
There are a few interesting things about that. One is I imagine those policy debates happening. Should the range be 0 to 1%? Should it be 1 to 2%? And that was after a period, like you said, of decades where inflation is nowhere near that. I think when Bernanke came to be Fed chair, which was just before the financial crisis, inflation had spent a very short amount of time below 2%. And of course, there is path dependency, and so we are now in this world where 2% is seen as this magic target. About 4 or so years ago, the Fed adopted a new framework called flexible average inflation targeting. How does this differ from just a strict 2% target?
That is a really good question because I think the ultimate idea of flexible average inflation targeting is that they're just not going to be quite as rigid in terms of how they pursue it. They would tolerate and, in fact, maybe even overshoot a bit if they had been under the level for a long time. Now, of course, when they announced the policy, that's exactly what had happened. We spent the better part of a decade before the pandemic, 15 years, in fact, with inflation bumping along close to 1.7%. And it's hard to believe now, thinking back on it. But the Fed was really bothered by the fact that they were running at 30 basis points below the target for such a long period of time. And so, coming out of the recession, the pandemic recession, they made this announcement roughly at that time that they would allow the economy to gain speed, and they were not even going to raise rates until inflation got all the way to 2. And the logic behind that, well, first, it reflected the fact that initially in the pandemic, prices plunged and we had negative inflation again for a brief time. But it also reflected the idea that there was this stickiness, that inflation was perpetually stuck at a very low level. So let's let it get all the way to 2, and we can always easily bring it back down again. And of course, in hindsight, boy, that might have been one of the most wrong things anyone at the Fed ever said.
Pretty serendipitous timing that they did allow for more flexibility in their framework just in time for the period of our highest inflation in 40 years. Now, Mohammed Al-Arian and a few other commentators have suggested that central banks should actually increase their inflation targets above 2%. And as I understand it, they argue that there are a lot of secular forces in the global economy right now, things like deglobalization, rising energy costs, maybe demographics, where a target closer to 3 or 4% would be preferred. What do you think of that? Are there any big drawbacks from it? I mean, in a very simplified world, the Fed could change their target to 3 or 4% and say, hey, look, we did it. Mission accomplished.
I think the biggest issue is, we're coming out of a period where Japan had negative interest rates for years. Europe had negative interest rates for years. And when they first went into that negative rate regime, I can remember people writing that, boy, the European banks are going to suffer if they have to pay to keep deposits at the central bank and if they're lending at rates, close to 0. And in fact, there were 0% mortgage rates issued in Europe. And the bank said, don't worry about it, because the ECB's only going to have to do this for a year or so. It's a price we're willing to pay. And then it was almost as though they were trapped in that environment. And in a way, the extraordinarily low interest rates actually restricted the flow of credit in the economy, because who wants to make a loan if there's no payoff? There were better places to put capital to work. So I think a huge part of this is the realization that the negative rate experiment failed. At best, it was mixed, but more likely, it was worse than the alternative. One way to avoid negative interest rates is if interest rates are higher to begin with at the start of economic downturns, and that's more likely if inflation is higher. to begin with. So the primary goal of the people who started this conversation, people like Larry Summers and Olivier Blanchard, was the idea that maybe we want a little more cushion above the zero lower bound so we don't have to do things like resort to extraordinary Fed policy like QE every time we have a recession. Then there are others like El Arian, who you brought up, who are simply being pragmatic. It's going to be very difficult to get to 2%. So why not let it run at 3, which is effectively where we are right now. And by doing that, the Fed could allow the economy to grow at a rate where we could actually fully absorb all the people who want to work. Certainly some of the short-term pain would be alleviated.
I get the sense that the people who argue against changing the inflation target is that it really destroys that credibility that central banks have worked so hard to get. Since Paul Volcker, but also just around the world, the ability for central banks to control inflation is quite tied to whether people believe that they can. And this is not something to take for granted. I think we can see in less mature economies where the central banks are maybe more connected to politics, or they just don't have the track record that the Fed does. There is a much bigger struggle to convince financial markets that they're going to get inflation under control. And so is there a worry that if the United States changed its inflation target from 3 or 4%, it was just a way of saying, okay, we lost and we are changing the goalposts now because we were not able to get inflation down to 2%. And so for a long time, people might think in the future, well, how can we really trust what you say when you say that you are going to bring inflation down to your target?
You nailed it. That's exactly right. And in fact, I think that's a huge fear at the Fed in particular, that even having this discussion or engaging in it, taking it seriously, is is a threat to Fed credibility and therefore could make it more difficult for the Fed to do its job, not only this time, but in the future. Ironically, when the Fed adopted a 2% target, Ben Bernanke actually said it's not set in stone. If it turns out that's not the right target, we can always change it in the future. But I don't think he realized how much it would be tied to inflation expectations and so forth. And I think you really see that, for example, since we've developed a pretty robust market for TIPS, the Treasury inflation protection securities that pay in real terms, and then you get whatever the actual inflation is on top of that. From that, we can see what long-term inflation expectations look like. And they are volatile from time to time, but they tend to return to about 2.25%. And 2.25% with the CPI, which is what the tips are deflated by, is consistent with 2% for the PCE, which is the Fed's preferred measure. In other words, that is the bond market believing that the Fed can and will achieve its target. If we go to 3, then immediately I would expect you'd see that rise to 3.25 or even higher right away. So it would be like an instant interest rate increase across the economy.
I am quite convinced by arguments that the Fed's credibility is something that really should not be thrown out, and any changes to the inflation target really need to take that into consideration. But I do want to give some kind of weight to the arguments that people have when they argue for these higher inflation targets. And to me, the best way to consider whether raising the target would be a good idea is to take a look at whether the Fed is set up to fail in the current environment. Essentially, assuming political independence and the idea that the Fed is reactive to the things that are out of its control, is it more or less impossible for the Fed to bring inflation down to 2% without causing a recession? I should note, of course, that we are still in the middle of this cycle, so we don't know for sure whether the Fed will manage a soft landing. But Chris, looking back, do you think that the Fed could have brought inflation down to 2% by now without causing a recession had they raised interest rates earlier or more intensely? In other words, Are we still dealing with above 2% inflation right now because the Fed made mistakes?
Maybe. I think, one of the beautiful things about hindsight, right, is that there are no mistakes when you're making decisions after you've already seen the outcome of the other choice. But putting that aside, they didn't tighten. And I think they had really good reason not to tighten. When they made that decision to finish quantitative easing, for example, and delay rate hikes until after QE was done, that decision was made when the Delta wave of COVID was moving through the economy. And even though it turned out to be less severe than some of the earlier waves, up until that time, the economy came to at least a brief standstill every time we had one of these COVID waves. So, ironically, as we're recording this just a couple of days ago, Fed Chairman Powell came down with COVID again. From what I know, it's his second time. And people aren't really concerned, right? Because it doesn't hit as hard as it did back then. Survivability is much higher. We know how to treat it better than we did. But nevertheless, when they made that decision, it was still seen as this terrifying disease that was ripping through the world. So I don't blame them necessarily for waiting. But I think once they did start to tighten and inflation hit past through 5% to 6 and 7, they probably should have stepped up the pace and moved in faster increments sooner. But even then, obviously they didn't. And now we're coming down from that very elevated level. And I think something you wrote in actually the inflation lab that we ran in the weekly recently struck me as a really good metaphor for a lot of what's happening with inflation today. And that is what's happening to prices in the transportation sector. That we had a chip shortage related to the pandemic. And that caused a shortage of new cars. And that caused used cars to be driven longer and therefore a shortage there as well, plus the demand from new shifting to used. Those prices skyrocketed. And then we had a period where automakers are trying to get cars back on the lots and we didn't have enough parts. And so parts prices went up. And now, years later, chip shortage is resolved, was resolved ages ago. But years later, we're seeing 22% inflation in auto insurance rates because parts prices are higher, replacement costs on vehicles are higher, and so on. So there's this stickiness in inflation where high prices beget high prices. And when I think back to when I started in the industry, we had restrictive Fed policy more often than not for years. Through the early 90s, for example, Alan Greenspan talked constantly of leaning against the winds of inflation, even though we were far from full employment at the time. And still, it took years for inflation to finally come down to 2%. And I think that may be the case this time, that even with a recession, we don't necessarily get back to 2% even until later in the next cycle. We could be stuck at 3 in this one for sure.
I think there are a lot of important things that you just mentioned. But first, I should point out that we don't have any good examples of countries that did start raising interest rates early. So it's hard to know with much confidence whether earlier tightening would have done the trick. I do get that question from a lot of people who are understandably frustrated about inflation over the last few years. Well, why didn't the Fed start in April of 2021? And it's unfortunately difficult to know how effective that would have been, especially when so many of the problems we have seen cause pandemic inflation were supply side issues or these lagged impacts that you just talked about that the Fed doesn't really have much control over. They couldn't cause the increase of production of semiconductor microchips. In fact, raising rates might have slowed down investment in those plants. But when you were on the podcast about a year ago, you pointed out that this part of inflation that we have right now, the so-called last mile, is cyclical. and it can be sticky, and in many ways is tied to a strong labor market. Would this last mile be causing problems for the Fed no matter what? And does that mean that bringing it lower would be inconsistent with a strong labor market? Ergo, a soft landing isn't possible. Essentially, can we have a low unemployment rate and still be able to fight that last mile?
Believe it or not, Will, I'm more optimistic than I was a year ago. And the reason is that the unemployment rate has increased from 3.4% last April to 3.9% now. It's happening primarily because we have new entrants into the labor force. But that means there is a pretty significant pool of unemployed. It means that companies have more options to control costs. For example, the ratio of part-timers to full-timers has risen. That's a pretty good indication that companies are feeling more comfortable about dictating terms rather than taking terms from the labor side. Wage pressures have abated as well. Average hourly earnings have consistently come down from their peak levels. And, a year ago, we're close to 6, and now they're close to 4% year on year, according to the average hourly earnings. And of course, the ECI has come down, although last quarter was a little bit bumpy. I think you put that together with a lower quits rate and with fewer job openings and so forth. And I think that the Fed has managed to maintain restrictive policy in the sense that they're building labor slack in a way that few people thought were imaginable without a recession. We've never had a half point rise in the unemployment rate sustained without a recession. This could be the first time. And it's because serendipitous is the word that you used earlier, this huge influx of immigrants. And with that, of course, comes problems. But one of the benefits is at a time when we didn't have enough people to produce the goods and services we needed to meet demand. Well, now you've got more people.
To your point, the super core, the core services excluding shelter measure of inflation that the Fed likes to use, super core inflation fell from about 4.5% to 3% at the end of last year without a huge increase in the unemployment rate. And so wage pressures, to the extent that they're connected to super core consumer prices, did see a lot of moderation, and this suggests that we were able to get a more balanced labor market with the super core coming down. But the other part of high inflation that I think is still keeping the Fed up at night is shelter prices. And so let's say in this ideal scenario where we avoid a recession and the Fed has the best possible policy, whether it was earlier, more aggressive, what have you, the labor market still stays decently strong. And historically, when there is a strong labor market, that means people have enough job security, enough labor income to spend on housing. And all of that robust housing demand runs up against a pretty inflexible housing supply in the best of times. Throw in some big domestic migration earlier in the pandemic to put pressures on shelter prices, and as you mentioned, a good deal of foreign migration. That means there is a huge mismatch between housing supply and housing demand. And of course, those forces are entirely out of the Fed's control. Is there a path to shelter inflation stabilizing at a rate that would be consistent with the overall 2% inflation target that does not break the labor market? Can we see shelter disinflation without a huge increase in the unemployment rate?
Yeah, I mean, it should be doable, given the fact that the housing market is itself a market, and supply and demand fundamentals, you would expect that with prices rising, demand strong, eventually you're going to get adequate supply. But it's one of those markets where it's slow moving. It takes a long time to find a place to build and then to get the permitting done and the approvals and the architectural drawings together. It takes years. So it is very sticky. And I think, look, this brings up another, I think, really important point, which is the difference between the PCE deflator and the CPI inflation measure, because the CPI is designed as a cost of living index. The PCE is simply the deflator for those expenditures that make up consumption within GDP. And there are places, one that you pointed out to me was the way that auto insurance is reported in the two series. In the PCE, it's a margin where it's how much auto insurance costs less the cost of the cars and car parts and so forth that are bought by the insurance company, because those are going to be somewhere else in the GDP and they'll be accounted for elsewhere. And you don't want to double count inflation. You don't want to deflate twice. But when you're thinking about somebody's cost of living, rent and home ownership is a huge part of people's budgets, and they're better reflected in the CPI than they are in the PCE. And of course, if you're paying 22% more for auto insurance, that's the cost you paid. And I think the CPI is more accurate in that sense too. So given the Fed's sort of collective understanding within the Federal Reserve of how inflation works and how it's related to expectations and how expectations reflect people's costs and anticipated costs, I think the Fed has done a really good job of sort of toning down, not insisting that, well, the measure we look at is behaving better, but actually paying attention to the CPI. I think it's appropriate and they should be doing it.
I want to respond to that, the kind of shelter prices aspect. And it's my last attempt to give a good argument in favor of shifting the Fed's inflation target, because I think in all those arguments, what we've seen this cycle, the challenges that the Fed has faced and has no control over, it is possible that bringing inflation down to 2% without causing a recession just isn't something that's in the cards. So as you mentioned, shelter prices are a particularly big part of the consumer price index. Overall, it's about a third of the CPI, and a big part of that shelter component is owner's equivalent rent, OER, and this is meant to simulate what homeowners would pay themselves if they were renting to themselves. And of course, these represent transactions that never actually happen in the economy. And as you said, the CPI has these differences from the PCE that are intellectually justified under the premise of, okay, well, we need to figure out what is the cost of living, and sometimes the answer to that is not so obvious. But I want to then take a look at Europe. So in a lot of European countries, the way they measure their inflation indexes is different than the US, and not only because the representative basket are different, their citizens live differently than Americans, but they also just make certain choices in the same way that we did for CPI and PCE. And so there is something that tries to standardize all those methodologies called the Harmonized Index of Consumer Prices. You can recognize it on your Bloomberg terminal as HICP. And something in that HICP is a totally different way of measuring housing costs. So just like PCE, housing costs are seen more as an investment rather than consumption. And I kind of just throw this out there because the BLS actually publishes an HICP, and by that measurement, core inflation in the US has actually been about 2% for the last 6 months. And so we can take as given that the BLS is going to measure shelter costs the way they do, but a choice was made at some point, and this choice is causing a lot of difficulty for the Fed, and it's possible that it means that they can't break that stubborn shelter inflation without causing a recession. So that's the end of my argument. I don't know if you have any thoughts. I know this is another way of moving the goalposts, of course, but I think it's worth reviewing when we think about a longer term impact of potentially changing the inflation target.
Maybe it's a way to think about it, but I do think it's dangerous to declare victory over inflation when such a significant part of the monthly budget is in fact running amok. And particularly when you have an increasing percentage of the population that is renting rather than owning, when you have, more and more people sort of doubling up in apartments and so on, I think it's probably a good idea to have some shelter element. And of course, remember too that when we switched from the way we used to measure house prices, that the Fed used to use average monthly mortgage payments as a proxy for home ownership, which honestly was, well, it was a more honest way of measuring the cost of home ownership. But the problem with that, as we've seen with mortgage rates jumping up above 7%, is that people stop moving. And as a result, the average effective mortgage rate rises very slowly compared to the marginal mortgage rate. And so you can get increases that go for years, even after mortgage rates start to come down. They didn't want that in the CPI because they didn't want people to recognize that inflation was actually still rising. They wanted them to think we had turned the corner. So by that measure, inflation now is probably 7 or 8%. And that's also probably a better reflection of how people actually feel like about inflation now. So I think we've already made maybe enough compromises to pull the inflation indices down from the actual cost of living. And I think the better way to deal with this is leave the indices the way they are, but have an adult discussion about where the target should be.
I think what you just pointed out is really important to keep in mind, but I want to use that concept to segue into my next question because a lot of the things that we take for granted, whether it's the methodology of how we think about inflation or even the Fed's inflation target, is not set in stone. There is some flexibility. And so, if it was only 12 years ago or so that the Fed explicitly adopted its 2% inflation target, I'm sorry, you said it was right before the financial crisis. Is that right?
It was actually right around 2012 that they adopted the official target.
Great. So, 12 years ago. What do you think is the likelihood that they do change their framework? Is there a set time where they are going to review their current framework and we could see some tweaks? I think it's pretty fair to say that they are not going to change it by the end of the year. They're going to roll out a big review process so the public isn't shocked. Maybe it takes as long as the Basel III Endgame proposals, but there is the potential that they change their framework. Is there anything set on the calendar there where they are due to make that review, or is it just always TBD about whether we could see a different inflation target?
No, absolutely not. There's nothing on the calendar. And in fact, Jay Powell has even discouraged speculation that it would happen. My sense is that one of the things you're very aware of at the Fed is the importance of that target in setting inflation expectations. And while they're trying to push inflation lower, the last thing they want is people starting to doubt their mission. So I suspect it's the kind of thing that, well, I can see this playing out two ways. One, they have quiet conversations within the Fed, realize this is something they want to do, and announce it as a fait accompli. That's one possibility. I think that's probably the least likely, but it could happen, I suppose. I think more likely if they do change the target, it would be after we get back to 2%. And after all, there's going to be a recession eventually. Every cycle ends in one. And when we do have a recession, I would think within a year and a half after we come out of that recession, inflation's generally about 2 percentage points lower than it was on the way in. So if we go into it at 3.5, we come out of it at 1.5. And that would be the time that you could have a public discussion about raising the target without worrying about undermining what the Fed is trying to do. Because, of course, at that point, they'll be trying to goose inflation higher anyway.
I think that's totally correct. The Fed will worry about his credibility, and they can't even provide hints that they would consider the chance of changing the inflation target until they have actually successfully brought it down. But I want to end with a question that is mostly in the realm of speculation for now, but what do you think changes if the Fed's inflation target goes from 2 to 3%? Do certain financial assets become more or less attractive, and who would be the winners and who would be the losers in such a scenario?
I was so hoping you were going to go there because this entire discussion is framed in terms of central bank policy and whether it's hard to get to the target level or it would be easier to do it this way or that way. But if we did have a higher inflation target, if we did allow inflation to be higher, there would be winners and losers without question. The biggest losers in a high inflation environment include people like low income wage earners, particularly in the initial phase of recession and recovery, because there's labor slack. It's hard to win wage concessions at that point. And so that they would fall faster behind on their finances than they would otherwise. The high inflation in the 1970s ironically destroyed the people on fixed income in ways that it doesn't seem to do now because Social Security now is indexed to inflation and people are protected from that. I think that's another actually key element. One of the arguments I hear all the time is if we had higher inflation, we could inflate our way out of the deficit. The problem is almost everything in the federal budget is indexed as well. So that would become more expensive. Uh, if you look at growth in the real deficit, it tends to be fairly steady over time, more so than nominal. In other words, I don't think that is going to work very well for anybody. Of course, it would also mean that interest rates would be higher, which means interest on the debt would be higher. And that would increase the burden there as well. Finally, you talked about financial assets. The hedge against inflation is to own stuff rather than owning sort of hypothetical. You don't necessarily want to be a lender in a rising inflation environment. So bonds don't do well when inflation accelerates, although they're fine once inflation stabilizes at whatever rate. The stock market tends to compensate for inflation because that is ownership of a real thing. Bitcoin as a dollar alternative does well. And then if you can find a central bank that maybe takes inflation more seriously, foreign currency and foreign investments do well also. But that's a tough one if you're American, because the dollar is the world's reserve currency. And as we saw after the pandemic, when we unleash inflation, it tends to go global.
Chris Lowe, thanks for coming on the podcast.
Thank you, Will.
That was Chris Lowe, Chief Economist with FHN Financial. The biggest thing I take away from that conversation is how valuable the Fed's credibility is in restoring price stability. Central banks are able to bring inflation down in large part because they have convinced financial markets that they are able and willing to do so. Changing the inflation target would likely erode the credibility the Fed has worked for decades to obtain. On the other hand, the policy regime we have right now is relatively new, and it's not out of the question for the Fed to revisit its 2% target sometime in the future. Next Tuesday, the retail sales report for May will be an important piece of Q2 consumer spending data after April spending disappointed to the downside and increased expectations for a broader economic slowdown. The bond market should react to any surprises in the S&P PMIs at the end of next week, even if their connection to hard economic data has been relatively unreliable the last couple of years. To close out the month, the PCE report for May will be out on June 28th, showing how the May CPI translated into the Fed's preferred inflation metric and how consumer spending fared last month. With the Fed's June meeting in the books, FOMC officials are now free to speak publicly on monetary policy. A handful of appearances are already on the calendar, and we expect more to be added as time goes on. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.